Welcome to the Emotional Balance Sheet, the go-to podcast for parents with multiple kids, especially those with twins, triplets, or more, who are navigating the maze of modern family life and personal finance. Whether you're overwhelmed by education or retirement planning, parenting dilemmas, career transitions, or trying to define your purpose and plan, we're here to guide you with empathy, encouragement, and expertise. Hosted by Paul Fenner, founder of Tama Capital, a certified financial planner and parent to 4 kids, including a set of triplets. Our podcast is your ally in the quest for financial peace of mind, proving that money matters, but family comes first. Subscribe now and join our community of empowered parents at tamacapital.com. This podcast is for informational purposes only and should not be relied upon for investment decisions. Clients of Tama may retain positions in the securities discussed in this podcast.
What does comprehensive financial planning even mean? At Tama Capital, it means a family office where lifestyle planning such as retirement, college, portfolio management, and tax prep and planning are all under one umbrella. But it goes beyond numbers. We focus as much on the emotional side of financial planning as we do on the financial side. We get you. We understand your challenges of building a family, business or career, and a healthy life. We are devoted to wealth planning for families like yours because we are you. Learn how our family can help your family by visiting tamacapital.com. Hi, and welcome back. Well, we've made it to our last stage of financial planning related to our One Big Beautiful Bill series. And this last stage is retirement. So this episode, this stage of life is for those who are already in retirement. But as I've mentioned during each of the previous 4 stages that we've talked about, starting out, growing families, building years, empty nest, pre-retirement years, I think there's something in there for everybody that you can share with everyone. As I've mentioned time and time again, the really incredible thing about the development of my firm Tama is the legacy that's being built, and working with people my age that are parents that are grinding through raising kids, but then also working with their parents, the grandparents, but then also working with those kids, those Tama kids that I call them, that are just graduating from college, starting their careers. So it really becomes a generational family that I'm building here with Tama. And as I mentioned, if you have any questions about things I've covered, don't hesitate to reach out. Love to see how I can help and have a conversation with you. But let's get started with what this big, beautiful bill means for those that are already in retirement. And I would actually say that retired people benefit the most from the big, beautiful bill. And there's a few reasons why. First and foremost, like I mentioned for every stage, but I think it's just as important for retired people already in retirement, is the locking in of these tax brackets. It's knowing with some certainty that what your tax brackets are going to be. And that really helps from an overall retirement planning perspective when it comes to Roth conversion strategies, sequence of return risk, tax bucketing strategies that I've talked about before that I'm going to go into detail again on when to withdraw money from certain accounts. So those locked in tax rates are really helpful from a planning standpoint. The second is the standard deduction increase. But as I'm going to explain here in a minute, there's a special one for those of you that are 65 and older. And this is really big. If you're still working for some reason, maybe you have a part-time job that can still qualify for retirement contributions, don't forget about the catch-up contributions. And I think lastly, the other thing that the big, beautiful bill locked in was this huge estate tax limit. So it increases the estate tax limit to $15 million and makes it permanent. So if your estate is under that threshold for single, or potentially, if you're married, could double it. And there's some planning strategies that I can work with on couples that are in that stage of life to really make sure that you're not paying estate tax, that's a real win. Also, we get slight increases in individual gifting because I know that becomes a bigger and bigger priority for some people that are already in retirement, ensuring that you're not paying any gift tax on those that you're gifting. So, with that being said, I want to share my screen and dive into this expanded senior deduction, which you may have already heard about. So as I mentioned, if you're 65 or older, you can take an additional $6,000 deduction through 2028. And again, that's another key, 2028. So it's only going to last a few years. And as I mentioned in some of the previous episodes on the One Big Beautiful Bill and the various life stages, they've made this bill more complicated from a planning standpoint because of only allowing deductions for certain periods of time, increasing income limits, decreasing phase outs, things of all that nature that make planning a twist here and a twist there. So you really need to know what's going on with this, or working with a professional such as myself. I'm an enrolled agent with the IRS and prepare returns for the families I work with. So it's automatic and you don't even have to itemize. I think that's another big deal because most people in retirement, and even if you're not in retirement, don't have enough deductions to itemize. So you're just taking the standard deduction. So this deduction is on top of that. So what do I mean by that? So a retired couple that's both 65 or older can now deduct $43,500 before paying any federal income tax. Okay, Paul. Well, how's that possible? So if you're married filing jointly, your standard deduction is $31,500 for 2025. Then again, if you're both 65, you get an additional $12,000 on top of that, which gets me to the $43,500. So that is a real win for retired people 65 and older. Single filers, again, we have these income phase outs. So if your modified adjusted gross income exceeds $75,000, that's when the deduction starts to become less and less, and it completely phases out if your modified adjusted gross income is $175,000. For married filing joint, that phase out begins at $150,000, and then you're completely phased out at $250,000. Now, you may be thinking, well, man, that's a lot of money. Well, not necessarily, because you think about potentially how much you're bringing in Social Security. And for those of you that have built up a huge asset base in traditional IRAs or 401k dollars, and you're starting to have to take RMDs, those can have a significant impact on your income. The good news is, and I'll talk about this in a second, when it comes to if you're still doing Roth conversion strategies, when you do a Roth conversion, it does not count against your modified adjusted gross income. It counts as taxable income, but there's an adjustment against your modified adjusted gross income. See how I mentioned how this can get complicated? So here's an example, joint couple filing modified adjusted gross income of $163,000. So they're $13,000 over that threshold. So their deduction is reduced by 6% of that $13,000. So rather than getting $12,000 of a deduction, they're only going to get $11,220. So this is where, again, at least for the next 3 years or 4 years, 25, 6, 7, and 8, this is where you could potentially manage your income level to take advantage of this deduction. One other deduction that I want to point out that I've talked about in the other life stages as well is this vehicle interest deduction. So for those of you that may have a new vehicle, this could be a benefit to you. And I'm bringing it up for those that are retired because your income level might not be that high. Because I want to come down here and talk about this income limit. For this deduction, if your adjusted gross income is over $100,000 if you're single filing, or $200,000 if you're joint, that this deduction could potentially get reduced 20% for every dollar over that threshold. So for those of you that may be in the market for a new vehicle, because this deduction is only on new vehicles, not on used, and the other kind of hurdle with this is that it has to be a new car assembled in the States. And the example I give, if you buy a new car that's assembled in Germany that's shipped over here, no deduction. But again, for those of you who are in retirement, your income levels may be low enough to take advantage of this deduction if you're buying a new car built here in the US. So what does all this mean? I think usually in the previous life stages that I've talked about the pros, the cons, and then the planning actions. And so I've talked a lot, in this phase about all these pros, the tax rates firming up for clarity around planning, the estate tax exemption being permanent, the extended senior tax deduction, which is huge, that $6,000 for single filers, $12,000 for joint if you're 65 and older, this vehicle deduction. In previous life stages, I've talked about the tips deduction and the overtime deduction. I didn't get into details on that one because most people in retirement aren't working. But if you're interested in that, go back to the very first episode I did about starting out. And while that may not be applicable to you, it can certainly be applicable to any of your grandkids that are older, that have graduated from potential college or even in high school, that work in a job where they have tips or overtime that you could share. But from a retirement standpoint, I don't necessarily see a lot of negatives that impact those that are in retirement with this bill, which is good because as I've identified in previous life stages, there's always a couple. And a lot of it stems from understanding when you can take advantage of these deductions, like the time frame, the years, and also watching your modified adjusted gross income or adjusted gross income to be able to take advantage of some of these deductions. So with that being said, what are the planning actions for those of you in retirement that you could take advantage of when it comes to this big, beautiful bill? And again, as I pointed out for each life stage, if you're already a member of the TAMA family, I'm already proactively taking these actions head on now. So there's no need for you to worry about it. But if you're not working with us at TAMI, if you're not part of the TAMA family, and these are of interest to you and you want some help or you have questions on these, feel free to reach out. So I want to start with Roth conversion strategies. As I mentioned, when you're doing a Roth conversion, it's not impacting your modified adjusted gross income, which is a key driver of the expanded senior deduction. So again, when I'm looking at working with people in retirement, I'm trying to stay within certain confines of your adjusted gross income. So I'm not creating additional tax exposures for you, for example, for increased Social Security tax or increased Medicare taxes. So there's a whole strategy, a planning element to taking Roth conversions when you're in retirement, but they can still be a really great planning tool for you, especially if you're trying to minimize a potential tax liability down the road when required minimum distributions kick in. Next is the sequence of withdrawal that I've mentioned earlier. And really what I'm referring to this is being able to maximize your after-tax return. That's really becomes a key focus for me when it comes to financial planning and retirement. So some years you may want to take money from your Roth. Some years you may want to take money from traditional assets. Some years you may want to take money from a taxable brokerage account. So it's being able to pull from these various different savings vehicles that you've built up over the years in order to maximize your after-tax return and minimize your overall tax liability. That's why it's essential, I think, as part of the early planning process to have a little bit of money in each of those buckets. Do you forgo a tax break today? Yes. But in the future, down the road, you end up likely getting that back and more. The next part is locking in healthcare funding. So if you're already in retirement and you're 65, more than likely you're on Medicare. So there's Part A, Part B, Part D, Medigap policies. I'm not going to get into all the details on that, but there's some additional planning that could help you there. But healthcare is one of your biggest expenses in retirement, goes without saying. So making sure that you have a good understanding of what those costs are year in and year out is key to overall successful wealth planning. As I mentioned a couple times now, the $15 million state tax exemption was made permanent. So it's always key to revisit estate planning and gifting every year. So the last thing you want to do is make a gift and it becomes some taxable event for you. From those lines, charitable giving for tax efficiency. This is one thing I've talked to a few of my families about that are in retirement, about the potential use of what's called donor advised funds. This is one way, if you're still trying to itemize or itemization makes sense, you can basically bucket your charitable contribution. So say rather than making contributions of $5,000 every year, make one $10,000 contribution that may have you itemize and lower your tax liability if possible. So there's different gifting and charitable strategies that we can utilize and take advantage of, again, to help minimize your tax liability and maximize your after-tax return. And then the final point I want to make is with the One Big Beautiful Bill, it now has a universal charitable deduction. So even if you do just take the standard deduction, and if you're married filing jointly, that should say MFJ, then you could take advantage of this $2,000 deduction as before. If you wanted to take a charitable deduction, you had to itemize. Well, now they're giving you the opportunity to take that charitable deduction up to $2,000 married filing jointly or $1,000 single, and you don't have to itemize. So that brings us to the conclusion of this stage and the overall series that I put together on how the One Big Beautiful Bill impacts you at all of these life stages, these 5 life stages that I identified. So again, I hope that you've found value in this. If you're not already working with us and have questions, like I said, reach out. You can find us on YouTube. I'm very active on LinkedIn. Our website, tamacapital.com, is a great resource. And the other thing I would say is I would encourage you, even though some of these life stages may not be applicable to you, they may be applicable to other family members that you could help, friends. So my biggest ask is to share this with others if you found value in it, which I hope you have. It's been a ton of fun putting this together. As you could tell, I really enjoy these conversations with you and trying to help educate and provide value. And again, I think the government has tried to simplify things and add deductions here and add deductions there, but in a lot of ways, they've complicated it again. So there's lots of planning opportunities, not only from the tax standpoint, but just from an overall wealth management standpoint. So again, anything I can do to help, please don't hesitate to reach out. Thanks again for tuning in, and we'll see you next time. Now that you've made it to the end of another great conversation, are you looking for more? If so, head over to tamacapital.com, where you will find all of our conversations. Use the search feature to find the topic or guest you would love to learn more about. Also, don't forget to make someone else's day by sharing our show. Thank you so much, and we'll see you next time.